Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading reports for August 10th, 2014. Market remains in bullish normal conditions. We're approaching volatile. On an annual basis with weekly RSI 14, we're in the high end of neutral at 58 out of 100. With the 10-day NDX short-term condition is we are in the lower end of neutral at 34 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is at 4.38%, so about 2.33% away from sideways markets. That's red bullish, meaning it's among the worst readings in the last 6 months. Slope of the 50 is almost flat at 0.08. That is a red bearish. ADX is at 29.4, a strongly trending bearish intermediate trend. ATR percentage still at the high end of normal at 0.98%. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. The current reading is at 0.84, which puts us into risk off conditions. We take that score of 0.84, compare it to the last 5,000 trading days, find the standard deviation. That gives us the risk Z, which is currently at a minus 2.06. So this reading is among the worst 5% in the last 5,000 days in terms of the relationship between the 10 and the 30 MA. You can see the time series of that reading here. We thought it might find support in here, but when it failed, this sets up a really nice VXX series of intraday trades. So that Z-score is now just below minus 2 standard deviations compared to the last 5,000 trading days, which is the last 20 years. When this turns, this makes a nice swing trade in the other direction in XIV. Blended month rebalancing, next reevaluations on or about 1 September. These are the current holdings. These are the current leaders based on Friday's close and varied by population here. In ETF2, the theoretical exposure remains at 60% and the model portfolio is at 60%. Yes, those are white wolves you can hear in the background, Tala and Yoki. Just a quick look at the blended monthly rebalancing holdings. You see about half are on a cash position in the 13. About half are on the cash position in ETF 32. You got China and the BRICS and the technology at the top. In ETF Max, still dominated by India and China. Everything India, everything China. There's some Thailand, S&P Biotech. Emerging markets, high beta, miners. In the S&P 500, this is the top 50 or so using the BMR lens, and it also shows what sector we're looking at here. Look at United States Steel looking like a growth company. Netflix is of interest with green on 3 months and yellow on 6 months. Chipotle, also green and white. International Game Technology, green and white. Vertex Pharmaceuticals. Alcoa. Now we're looking at the market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance levels. When they fail, they become price targets on the way down. The horizontal purple lines here are price targets to the upside should we actually see support here at 191. After excursion down here into the Z-3 range. The last 3 days have given a bit of hope. The dark blue shaded area is the 30-period Bollinger Band plus or minus 1, the river. And The lighter blue shaded area is the floodplain, that's plus or minus 2. The outer red lines here and then off the chart are plus or minus 3. You can see how we got down below minus 3Z. The blue horizontals, that channel is the 10-period RAF regression channel. It's the RAF regression channel. The center line is the actual regression line. The outer channel is formed by the maximum excursion during the look-back period. The black line is the 30-period channel. You see both tilted downward. See the river has rolled over. The dragon is this thin red ribbon. That's the 10-period Bollinger Band plus or minus a half, and so that turns much faster. It's now coming out of the river to the downside, and this will act as a resistance point to this price recovery. But should price get through there, then that's a favorable sign. It has to get through the dragon. You can see how in that long quiet up channel, the dragon was resting on the far side of the river, keeping price out of it, as it were, metaphorically. And then the breakthrough was an indicator the market had cracked. This sine wave looking line here is the slope of the 30-period regression line, and the blue circles are highlighting key turning points. That's it's below the zero line right now. So what we have is some support at 191 here at the bottom of the 30-period regression channel. Price has re-entered the floodplain. This would be an indication to buy at 194, then RLCO. You know, the Z pattern number 7, where you get Z less than minus 2, and then buy not later than Z minus 1, with an idea of targeting the Bollinger Band mean and then the far side of the river for the 2R. In the yellow zone here between about 193 and 198, let me shrink that a little bit so you can see. In this yellow zone, between 193 and 198 is where I take intraday positions based on market direction of that day. If it gets into the green or the red is where I have a intraday bias, and I'm looking to be directional that day in the primary direction of the market. You can see that the slope of the 30 has decayed all the way below this dotted line. That's 0. If it gets down to minus 0.22, that would be, we consider that steeply down. That's more than one standard deviation of steepness. We're not quite there yet, but this is actually a relatively significant downturn historically. So that's why, to me, in this bull normal, that this looks like a buy on dip opportunity to me, and I'm ready to take that Z trade recovery with targets at 194, 199. You can see that we've been oversold for quite a while here on %R. And the jaws of percent price oscillator, which finds turning points in the swing trend, still open to the downside, but slightly improving, so that's an indication of a potential intermediate term support level here at 191, which I would really count as, like, say, this 190. Violation below there, then it gets really ugly, and you know, the last 4 months of gains are over. So if it holds here, this would be a buy on dip, and the bulls would be wiping the sweat from their brow. Okay, moving on. ETF2 regional report. 6 out of the 10 regions are on buy signals, 4 are on cash. 2 of those are in the U.S. with the mids and the smalls. European 350 and the Euro-Asia blend. And so that leaves the strength inside emerging markets, Asia less Japan, Latin America, Brazil. The S&P at 73 is better than EFA, the rest of the globe at 67, so the U.S. is still favored region. Inside the U.S., it's tech at 79, then large cap 73, mid cap 71, small cap 70. It's 2 strongest sectors, emerging markets at 77 and tech at 79. The 2 weakest are U.S. small caps and EFA, the Euro-Asia blend. Inside the U.S., no exceptional strength here, but we would point at XLQ at 77, energy at 76, healthcare at 75, and then the weakness in the yellow here with industrials, staples, and utilities. World market model, you can see most of the U.S. is below average. Tech stands out. Some of the mid caps and then the S&P are above average, but otherwise the Dow, all smalls, and mid cap growth are below average. Asia, less Japan, and Japan are above average. All of Europe below average. You can see the leaders here in the Asian countries. Latin America and emerging markets still holding up well, along Canada, Mexico, and Brazil. Everything Europe is down. In the other asset classes, commodities are still suffering. Oil, gold, silver below average. Treasuries and U.S. real estate holding up nicely. Top 30 ETFs based on the ETF2 lens. Again, we like green and white, so we'd be looking at China, biotechs, Hong Kong, gold miners. You can see the India dominating across the board. Inside the Dow, Intel is massive goodness. Microsoft and Cisco, that's the strength in tech that we've seen. Goldman Sachs showing some surprising strength in the financials. The green and white, I would say they are looking like the financial leaders should financials turn around more broadly. Disney has recovered. Home Depot on the way back up, white and yellow. Morgan, white and yellow. And then the five losers are all red and then yellow, meaning that they are recently being crushed here. That's Walmart, Pfizer, McDonald's, Boeing, and United Tech for value plays that we might be ready to start looking at them for turnaround plays. Just a volatility recap and liquidity recap. Quick look at the daily report. Overreaction signals for Asia less Japan, channeling for Asia less Japan and Latin America. That's one that ought to be attended to and framed up because it's been such a leading strength region. You can see how the ADX is favoring the bears right now. Some good signals in the ETFs and the large caps with channeling and overreaction. We get 551s in Brazil, Latin America, a triple screen in Intel. Those ought to be framed up because of their leadership positions in their respective populations. And then a ton of good candidates here in the auto framer for those of us swing trading one day at a time. You can see Dow Tactical, a plethora of quality targets here in the auto framer. Here's the triple screen in Intel. That's nice. It was also a single-digit RSI 2, 2.3 to 1, and also channeling an overreaction. So we've got to frame that one up. In the ETF 30s, again, plenty of targets that meet the auto framer criteria. Some with a fraud quality number here. Look at the DBC, fraud quality number of 4. Real estate at 3. Russell small caps at 3 to 1. Again, you're looking at a 45-cent initial risk for the intraday trade on IWM. You have to be able to frame that one and be prepared for turnarounds or continued weakness. So that's in a critical state that we want to exploit. Too many good frames in the auto framer to focus on any to get them all, but there's still quite a few definitely worthwhile. I'm looking at XIV here in the middle. AT&T at 7 to 1, Verizon 5 to 1, and then a lot of the regression line fractals setting up nicely with very large reward to risk ratios on both sides of the extreme excursion. We'll cover some of those in the webinar tonight for members. You can see we're developing a little bit of stability here at 191 with the price now back up between the polynomial and straight line regression. You can see that the slope of the regression line has fallen a little over 3 standard deviations down to an extreme at 2. And so the turning point on the upside is when that thing finds support and crosses its own 10-period moving average. This is a blow up of that chart right there. And you can see that with price with respect to the 200 is down here more than 2 SDs below the 6-month average. And so the last 2 times it did that, there was and had a turning point. 2 nice moves. This went from like -2 or +2 to +8. So there was an 8% and a 6% rebound in the last 2 times that it did that. So if history rhymes, we're looking for a short-term swing rebound here in this bull. Historically, we're right at like -1 SD in terms of the slope of the 30. And again, the last time it got down at this level and then reversed over its 10 period, there was a really nice move on this bounce. All right, that's everything from Tortoise Capital. We'll review some charts of interest in greater detail in the webinar tonight. Keep your risk measured and your powder dry.